In this episode, I continue with part 2 of my interview with Bob Lai, who is the blogger behind the popular website talkhan.com. Bob and his wife started building a dividend portfolio in 2011. Today, their portfolio generates over $43,000 in dividends each year, and they did this on a single income with 2 kids while living in one of the most expensive cities in the world, Vancouver. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend podcast. Let's continue with part 2 of my wide-ranging interview with Bob. Now, so Bob, if you look at today's economic climate now, Bank of Canada recently increased the rates again. And in the U.S., same thing with the Federal Reserve. Last year, we saw a number of increases. Inflation still high. I believe the last numbers to come out were still a little over 6%. Everybody, everywhere you read, they're calling for, either we're in a recession right now or we're going to be in a recession this year. Does any of that stuff scare you? Are you changing the way you invest this year?
No, I'm not. I mean, if you think back in 2020, when February 2020, the market was start going down, people were freaking out because of COVID. I mean, who knew that dip was so short-lived, right? Because the bottom of that dip was probably in late March 2020.
Yeah, March
right?
2020.
And then it went up like crazy, right? So if you looking back, we were buying on the way down, and at one point our portfolio was down 250,000. That's $250,000. That's not a small amount of money. But we were buying on the way down, and obviously, we didn't buy. Probably, I think the bottom of that dip was March 22nd, if I'm not correct, if I'm not mistaken. But we didn't buy on that day, but we kind of bought on the left and right of it. And I think we did pretty well relatively, right? So again, back to what I talked earlier is when we have money, we try to invest regardless what the market is like. And that's kind of my view with this high interest rates, high inflation, potentially a recession, whether we are in it already or we're going to go into it. My thought was we'll just continue executing our strategy and, keep going at it, and eventually it'll come out. I mean, if there is a recession and the market tanks, that's if you're accumulating, it's actually really, really good because you're buying stuff at a discount, right? So I'm totally fine, if there's a fire sale, just like 2020 or even, during the financial crisis, I'm all for it, right? As long as you have the cash, that allows you to buy quite a few things at a discount. Now, if you're already retired or you're close to retirement, you might not like that because obviously your portfolio will drop quite significantly. But if you're relying on dividend income, as long as that dividend income doesn't decrease, that's fine, right? That's kind of the beauty of dividend investing is if you're relying on the dividend income and if the dividend income continue to grow, it doesn't matter what your portfolio value is. Now, a little bit of explanation there, right? Some dividend investors say, okay, I don't really care what my portfolio value is. As long as my dividend income is safe and growing, that's fine. Say I get 50,000 a year. Doesn't matter if my portfolio is down 50, 70%. I don't completely agree with that. My logic lies where I want my dividend income to grow, but at the same time, I want my principal to grow as well. Because if my principal is growing and if my dividend income is not enough, at least that gives me the option to sell some principal to supplement the dividend income, right? So that's kind of my logic. So I think total return does matter, even though you're investing in dividend income, dividend stocks, right?
I like that. That's a good way to look at it, right? Because then it gives you options, right? And like you said, if your dividend income isn't enough, but the stock prices have gone up, you can certainly sell some of the shares, and there's your income, right? You've added to it now. Yeah, that's a good approach. So the beginning of the question was, things seem bad, market recession, interest rates are too high. And I said, are you changing the way you invest? And your immediate answer, which I love, was no, we're going to keep investing the way we've been doing it. However, I'm going to play sort of devil's advocate here.
Sure.
In 2020, February and March, market tanked. And you mentioned, your portfolio was down $250,000. And for most people, I mean, I get emails from people that panic when they buy a stock for $40 and it goes down to 30. And they just panic. They just want to sell it, and they can't sleep at night. Where does your confidence come from? Is it you? Is it your wife? Is it both of you? Where does your confidence come from to say, you know what? All this bad news stuff is happening around us, but we are going to stick to our approach?
I think that just, I guess we, I think just being more confident with what we're doing. We've been investing for over a decade now, so we're comfortable with our investment decisions and such. But really, it's about, before you even pull the buy trigger, there are three key things that you have to ask yourself, right? Three key questions. I wrote about this on my blog. It's actually, in fact, one of the earlier blog posts I've written. So these three questions are: first, what is the upside of this investment opportunity? Two is, what is the downside of this investment opportunity? And three, I think the most important question is, can I live with the downside? Right. So when people invest money, unfortunately, a lot of time people only think about the upside. It's like, oh, I'm investing in Tesla today and it's going to go 4 times. Or if I invest in Google or Amazon or Apple or Royal Bank, in 10 years I'm going to double my money or triple my money. Like, people think about that potential growth, but a lot of people don't think about the downside, right? It's like, okay, investing, sure, over the long term, I think the average growth is maybe 8 to 9% a year.
Yep.
Right. But it doesn't mean that's going to grow every year. There could be, 1 year could be up 20%, 1 year could be down 10%, right? So it's up and down, but over time it's kind of going up, right? And unfortunately, people don't look at the downside. It's like, can you live with the stock down 20% or 30% 1 year, right? People focus too much on the upside. Now, what I say is, that third question, can I live with the downside? I think that's the most important question. Is that, are you okay when your investment is down 50%? Are you going to lose sleep over it? Do you have the itch to sell because you can't take that loss, that paper loss? Now, my suggestion is, you should really invest with money you don't need in the next, at a minimum, 3 years. Longer the better, right? Because if you invest with money that you need in the short term, you will end up being forced to sell at a time that you don't want to sell. So, for example, if you invest, say you want to buy a house, right? And then you're investing with your down payment. So you're investing your down payment, and you think you're going to buy a house in the next year or two, right? And when you've actually found a house and you want to buy, say the market tanks by 20-30%, say during COVID, right? February 2020.
Yeah.
And you found like your dream home, but all of a sudden your investment is tanked 20, 30, 40%. But you need money, so you end up having to sell. That is absolutely terrible, right? And that's why I say, invest with your money, with the money that you don't need in at least the next 3 years. Longer the better, right? And that's why we invest with our retirement in mind, right? That's kind of the idea, because you don't need to use that money until you're retired. So yeah, I think it's really about asking yourself about the downside, and can you live with it, right? Can you still sleep at night? Because some people can't sleep at night when a share price goes from $40 to $30, right? So it's again, it's even though investing is, in theory, it's very easy on paper, there's so much in here, right? It's how your mind reacts. And that's why when you see some people, invest with paper money, you could do that on quite a few online platforms. I'm sorry, that's not the same as when you start investing with your hard-earned money, right? It's just complete different psychology, right? And that's why I say, when you read these like investing blogs or YouTube and stuff like that, do these people actually have their money invested? That's kind of the number one thing I look when I discover a new blog or a new podcast or a YouTube channel. Is like, well, are they doing what they're talking about? Because that's very different, right?
Yeah, that is so important, right? And I like what you said about the difference between investing sort of practice on apps with artificial money versus investing with your own hard-earned money. It's two different things. And the temperament, yeah, absolutely. If you can't sleep at night at all and it's affecting your life, then maybe this approach is not for you. But because this approach requires you to be patient, like you said, long term, right? Mm-hmm. You never want to be stuck selling when the market is down 20, 30%. That's the worst time to sell. So temperament is key. When do you think someone should start investing in what we're talking about, dividend investing? Should they wait till they're in their 30s, 40s, and 50s? When should someone start investing?
Investing, well, I think the key phrase, I mean, the best time to investing was yesterday. The second best time is today, right? So start today. Now, I'm not your true dividend investing, because we invest in index ETFs as well. Mm-hmm. The reason for that is because when you invest, the way I see it is that when you invest in dividend stocks, you can only select a few, right? Call it, 20, 30 or so. We do own 49 individual dividend stocks today, and I would be the first one to admit that that's a little bit too many. I think the ideal number would be around 30. Mm-hmm. But even with 30, you it's not very diversified, right? It's even sector wise, it's not very diversified. Now, especially now, if you start looking into international, it's very hard. Like the diversification is not there. Therefore, that's why we invest in index ETF. So we own an Canada International ETF to diversify our portfolio, both from an asset point of view, also geographically, right? So that's my take. Now, if you're starting today, when I started, I didn't really know what I was doing. So like I said, I bought into ING and Manulife with my money, and looking back, that was probably a mistake, and I was fortunate I didn't sell during the financial crisis and kind of locked out over the years. But if I were to start today, I would definitely take a different approach, right? So if I were to start today, I'm in my 20s or even 30s or 40s, whatever. If I am not investing already today, and if I were to start out, I would look into invest in an index ETF first, allow you to get that diversification right away. And many of the brokerages allow for commission-free ETF purchase, right? So I could build on my portfolio without paying any fees. I would build that ETF up, call it, I don't know, 20K, 50K or whatever, like a sizable amount first. once I have a sizable amount, then I would start, if I want to invest in dividend stock, I would then start nibble on those, maybe like pick 5 dividend stocks or 10 dividend stocks. Because I think having that diversification at the beginning is very, very important. Because if you just start off like I did and bought like, one dividend stock, your portfolio may go down quite significantly, right? Because you don't have that diversification. So that's my thought. But to answer your question, Ken, the best time to invest is today. Like start today. If you're not investing, do it, because it takes years and years to build out your portfolio, and you really don't see that fruit of your labor until at least a decade into your investing.
Yeah, absolutely. It takes time, right? It takes decades and decades. And so what I tell people is start as earlier as possible, as soon as you can start. I had both of my kids started when they were 9 years old. So they each have their own dividend portfolio when they started at that age, right? Now they're much older now, and they've been investing for many, many years. So yeah, that's a good approach. Okay, I feel like we could talk about this for hours and hours about dividend investing. It's my favorite topic. It's my passion, and I just love getting information from your guests like yourself and inspiring everyone. So I have one more question, and then we'll wrap it up. I do want to respect your time. So the question here is: conventional wisdom states, and I'm going to put that in air quotes. Conventional wisdom says that the older you get, you need to start getting out of equities, start selling your stocks or even index funds, and start putting money into GICs, term deposits, and bonds. Do you agree with that or not?
Yeah, yes and no. So we're fully invested in equity. So I would say maybe 99% of our portfolio is in stocks. Maybe less than 1% is in bonds, just because through my work's RSP, we have to buy low fee mutual funds, and one of the funds is bond, because they allocated that percentage for us. So I think, going back to my earlier what I said, the beauty of dividend investing is assuming your dividend income is stable and it doesn't get cut, like the companies don't cut their dividends, it should be pretty stable, and it should grow over the years, right? Despite whether the interest rate is high or low. So with that in mind, in theory, you shouldn't need to buy bonds, right? Because the whole idea of bonds is to protect your in theory, bonds have an inverse relationship to stocks, right? So when stocks go higher, the bond kind of return not as well, and then when stocks go down, the price of bonds should go higher. So it's kind of a inverse relationship in theory. Does it always work that way? No, not 100% of the time. If you're investing in index funds and you're planning to do a 4% withdrawal, like withdrawals every year, yeah, maybe in some sense it makes sense to have some bonds and GICs. Again, we're talking about very, very theories and mathematical analysis and probability and stuff. For us, because we're investing in dividend stocks and getting stable dividend income, we probably will be staying with pretty high percentages of stocks, regardless of what we're doing, right? Whether we're closer to retirement or when we're older. And with bonds, like even with the interest rates going up now, I would still argue bonds are not yielding that great, right? I mean, when the whole 80-20, 60-40 study, that was like years and years ago in the 70s and 80s, when interest rate was in like 10% and higher, right? Yeah. So when back then bonds could yield 10, 15%. I mean, the inflation rate was pretty high back then as well. But with the interest rate being low, I mean, even with the raise several times now, we're still at about 3.5, less than 5% interest rates, right? So bonds really don't yield that high in comparison to dividend stocks. So I would caution to follow that traditional idea of 60-40, like 40 like percentage hold the same percentage bond as your age. I think that rule needs to be adjusted a little bit. But again, going to that question, should you hold more bonds as you age? Again, that just depends on who you are as an investor, right? Like if you sleep better at night knowing you hold some bonds or GICs, do it, because at the end of the day, you don't want to be losing sleep over your investment. Now, if you do that way, make sure you keep that rules like 80-20 rebalancing, because the danger here, and I've seen that, is that you start rebalancing and then you start selling and going out of whack, right? For example, I know a few people that was doing 60-40, so 60% stocks, 40% bonds. They during February 2020, they started selling their bonds to sort of rebalance on the stock portion, which is fine, perfectly fine, right? So 60-40. But what happened was when the stock market started going down and down and down and down, they started selling their stocks as well. In fact, they got out completely. They were sitting on cash. So a few got out basically end of March 2020 on 100% cash. And they didn't buy back until like late 2020. So they missed that run up completely. So they basically sold at the low point of the market and then didn't buy back in until maybe like 6, 7, 8, 9 months later, right? So that's very unfortunate. So again, it comes down to your who you are as an investor. If you're comfortable holding 100% equities, even older as you get older, if you're comfortable with it, fine. If you're okay with the volatility, potential volatility, it's kind of up to you, right? Now there's studies showing that if you hold, you kind of lose that return if you hold higher percentage of bonds over time. But again, it comes down to math and psychological matters. This again, how you sleep and who you are as an investor. So it's a very difficult answer to. It's not a one answer fits all type of question, right?
Yeah, absolutely. There's so many variables, right? And you've touched on all of them, right? Temperament, investor temperament is a big one. If you've invested in mutual funds your entire life or GICs your entire life, and now you're in your 60s and 70s, maybe it makes sense to keep some bonds because there's going to be too much volatility. And you've paid those MERs for your entire life, which is a huge hit. We didn't talk about MERs, but we'll save that for another future episode in terms of costs. But I'm inspired by the reader B, right? Like his story, him and his wife. I don't think let me know if I'm wrong. I don't think they're going to be selling their entire stock holdings and putting everything in bonds now that they're retired. So they're not doing that. So I'm inspired by their story and saying, okay, they've done well. They continue to do well. And I've been a dividend investor for over 23 years, and my income has gone up every single year, right? The portfolio size goes up and down, especially in March of 2020. It went down. But the dividend income has gone up every single year. And that allows me to sleep better at night.
Exactly.
So Bob, where can people find you? Are you on Twitter or Facebook or your website, blog? Where's the best place to find you?
Yeah, so the best place to find me is probably on my blog. So that's tawcan.com. Tawcan, that's basically short for Taiwanese Canadian, is a word I came up with. So you could read about my articles on there, and then I'm pretty active on Twitter. So it's at Tawcan, again, TAWCAN. Yeah, or if you want to send me an email, feel free to do that. I get a lot of reader emails, and it's always fun to communicate with readers, and like reader B, right? Like that turned out to be a phenomenal exchange
Mhm.
via email, and we were able to share quite a bit of exchange quite a bit of knowledge. It was awesome, right?
Yeah, that's incredible. It's incredible how many people you meet in person or even online. Once
Yeah.
you've got a blog set up and everything, that's great. I want to let everybody know. Go check out Bob's site. We're going to put a link in our description below. Incredible! Like your blog articles are amazing. You've got a lot of detail in there. They're inspiring. I hope they motivate a lot of other people to start looking at this approach to investing and kind of rethink conventional wisdom from what they've learned or didn't learn in school about investing. And so it's a great resource. So I want everybody to go check out Bob's site. Bob, I want to thank you so much. I'm honored for you taking the time today to share your knowledge, your experience, and answering all of our questions. So thank you for being on our podcast today.
Yeah, no problem. Thanks for having me on. It's been a pleasure talking to you.